In fact, interestingly, I always remember one of our young investor couple
Okay.
who are our customers. They wanted to climb Mount Everest.
Wow.
Digital gold is a no-no because what is being sold in the market as digital gold does not have the backing of real gold. Nitin Kamath from Zerodha, founder of Zerodha, he recently made a comment that just one visit to a hospital nowadays can just make you bankrupt. It's a big no. It's a big no. See, this is again, I would reiterate, it is very, very important to consider investment for long term and not to consider that as a gamble. It goes down, then you get screwed up royally.
Got it.
So never do that is my advice. So my advice is, don't, if you want to, get high, don't use stock market to get high or don't use FNO, use some other means. So if 10 more years someone can continue, you will have a mind-boggling figure of almost 30 CR. And we spoke about compounding and basic tenets of wealth creation. I would say compound not just your wealth, but also compound your good karmas.
Hi, welcome back to LSD with Kishore. In today's podcast, we are diving into the world of personal finance, an area that's crucial for everyone yet often overlooked. Managing your money smartly can be the difference between constant stress and financial freedom. Meet Deepak Jain, an IIT Roorkee grad with an MBA from IIM Bangalore who spent 15 plus years with top companies like Infosys, SAP and Tech Mahindra. In 2014, he decided to venture into the personal finance space by co-founding FinAtoZ along with his partners co-founders Shailendra Kumar and Shrikant Kolha. What's FinAtoZ? As the name suggests, it helps working professionals manage their personal finance, from investments, insurance, real estate planning, all in one place. Over the last 11 years, they have grown substantially as a team, now having 25 wealth experts managing assets of 700 families to the tune of 900 crores. Hi Deepak, welcome to the show. Shifting from a career in IT to becoming a personal financial advisor is quite a change. What motivated you to shift to entrepreneurship?
I would say that we have to leave certain things to destiny.
Okay.
I was a happy and a successful IT professional. Happened to be in Satyam in 2008, 2009. If you would recall,
Yeah.
Our founder went public and spoke about such a humongous fraud, or you can say.
Right.
And then my fast friend and my partner also, Shailendra, he invited me to visit a startup event that time. So it just happened we both went there, and then we felt that we want to start something on our own. Both me and Shailendra were de facto financial advisor in our respective companies, if you can say that.
Great.
Our colleagues, even superiors, used to come to us to get financial advice, especially on their ESOPs. So then we just dug deep once we got this idea, and we figured out that IT professionals are not so good in managing their finances. And there was a lot of rampant mis-selling that used to happen those days, maybe even now. So we said, okay, it's a good idea. We like this. We are passionate about this. We are just giving free advice. Why don't we charge for it? And that's how we got into this profession.
Okay, Deepak, as a financial advisor, for the benefit of my viewers, what is the advice that you would suggest when, if someone is starting their financial journey as a professional single or a newly married couple?
So you're talking about young professionals essentially. And
absolutely.
See, my first advice or recommendation is to start with a purpose. A purpose could be, it could be as simple as I want to retire early, I want to achieve financial independence. Or it could be some exotic financial goals like, regular holidaying or buying an expensive car. In fact, interestingly, I always remember one of our young investor couple
Okay.
who are our customers. They wanted to climb Mount Everest.
Oh, wow.
Yeah. And they planned for it.
What is the kind of investment that goes into climbing Mount Everest?
At those times, we planned for around 10 lakh rupees of one-time investment, and I'm sure they would have already invested in the gears. And once you have the purpose, then the next thing that is very important is to cover the risks well. In fact, I recently read Nitin Kamath from Zerodha, founder of Zerodha. He recently made a comment that just one visit to a hospital nowadays can just make you bankrupt.
Absolutely.
So any financial plan can go haywire if you're not covered properly in terms of health, as well as in terms of life. And we have seen that people don't cover their life and health both appropriately. They think that they have taken some insurance and they feel that it is good enough. So it may not be good enough. So once these two aspects are covered fairly well and you have a reasonable financial plan in place, then comes the execution. And execution is not as simple as it sounds. It is, in fact, you need a lot of discipline and patience in terms of investments. Now, patience comes with conviction. And conviction comes with understanding the basic principles of wealth management.
Okay.
Very unfortunate for all of us that no one teaches this in any university. In fact, you take any university in the world, no one teaches this. So this is something that you have to invest your time to get into that, or you take help of a financial advisor to fill the gap.
Got it.
So then only you will be able to really do well in investment journey.
Got it. Deepak, you just mentioned about principles of wealth creation, right? What are the basic principles of wealth creation? Can you please share an example with me?
Yeah, it's a good question. I'm sure you know Einstein.
Yeah.
So Einstein once said, compounding is the eighth wonder of the world. So the basic principle, if you want to talk about that, is actually compounding.
Okay.
Now let me give you an example, as you said, and I'll be asking you some question now. So I'll just take an example. Let's say someone recently came out of college. Young guy, young chap or a girl, let's say 21, 22 years of age, and can they afford to invest 10,000 per month?
Oh, that should be easy.
So let's say they invest 10,000 rupees per month and they continue to invest 10,000 per month for the next 10 years. Without increasing it. Because there may be periods of ups and downs. So I'm just taking an average of 10,000 per month. Assuming a 12% kind of returns, which is 2x of FD, it will accumulate towards 22 lakhs approximately.
In 10 years. 10,000 invested every month. For 10 years.
For 10 years.
22 lakhs.
It will become 22 lakhs. So now let's say he or she is in early 30s. Now let's say she continues for another 10 years. But I will make a change here. Every year, the condition is that she has to increase the investment by 10,000. So first year is 10,000, next year is 20,000 per month for the entire year. Third year is 30,000 and so on.
This is from the 11th year to 20th year.
11th year to 20th year.
Great.
Will be fairly possible because you have already arrived in your life, you are already doing something which is reasonable, and this much can be
salary
spared.
Is increased up
salary is
over 10
increasing
years.
over 10 years.
Great.
So any guesses how much it will amount to after total of 20 years now?
Should
10
be
plus 10,
should be 50, 75 lakhs.
So you'll be amazed that it will actually come to almost 2 CR. So that itself is, you can now realize the power of compounding. Now let me say that you continue like this for another 10 years. Just like this. Then how much you think it will?
2 CR should become maybe 5, 6 CR.
You'll be amazed to know that it will be almost 10 CR. 9 CR to 10 CR in that range. Assuming a 12% compounding. And you will be really astonished if I tell you that if someone can continue for 10 more years. Typically 30 to 40 years is the life where someone is working. So if 10 more years someone can continue, you will have a mind-boggling figure of almost 30 CR.
Oh, that's really fascinating, Deepak. So just starting with a very average salary, average savings of 10,000 per month for first 10 years, and then slowly increasing by 10,000 over every year per month, one could end up having 30 CR. It's unimaginable. What else is required, Deepak, other than starting to invest and not just save? What else is required for you to scale up and substantially have substantial income?
It's not so easy because, as I said, investment, you need a lot of patience and discipline.
Right.
Yeah. And you also need a lot of conviction.
Yeah.
So the journey is not going to be like a straight line.
Yeah.
Unlike when you invest in a fixed deposit kind of an instrument, your money just goes in a straight line.
Yeah.
Though
Linear growth. Yeah.
Linear growth. Though the level of returns are less, but there is no volatility.
Yeah.
Now, if you want to invest and make money which is more than FD, you need to invest into some volatile asset class, be it equity, be it real estate, or be it gold.
Yeah.
So the moment it is volatile, there will be periods of ups and downs.
Yeah.
And there could be substantial periods of downside. So to stay the course and to keep on investing and not getting the idea of withdrawing from that is very, very difficult. So either you need a hand holding from some expert, or you can also look at some kind of diversification to smoothen the journey. Yeah. So if you invest into various asset classes and not just a volatile asset class like equity, but you combine it with some debt or FD for that matter, some gold and some real estate, maybe a tinge of international equity as well.
Okay, got it. So you're basically talking about asset allocation, which involves diversifying
some kind of diversification.
Got it. Deepak, now that you're mentioning about asset classes, broadly we have debt, equity, gold, real estate. For this particular conversation, let's stick to equity, gold, and real estate.
Sure.
So let's start with equity, Deepak. If a young professional needs to start investing in equity, what are the ways in which they could invest in equity? Is it directly into stocks, or should someone try out mutual funds? What are your views?
Yeah. So there's a reason why mutual funds sahi hai. Yeah. So let me give you an analogy.
It's a great campaign run over the last 10-15 years.
It's an amazing campaign, and people have really connected well with this campaign, and they've understood the power of mutual funds.
Yeah.
It's an amazing instrument. But let me tell you with an analogy to just explain you the concept. So let's say you want to build a house. What do you need essentially? You need a good plan. An architecture plan. You need maybe a good quality cement.
Absolutely.
Some bricks, steel rods, tiles, etc., etc. And then maybe you can build it. But do you build the house on your own?
No.
Obviously no. So what you would do is you will hire an architect to first design. Then you will hire a good construction company. A contractor who has a good quality labor. Skillfully they will mix all the ingredients, high quality ingredients, in the right proportion. And then only they'll be able to deliver you a house which is strong, elegant, and stands the test of time.
Right.
Same thing goes with investments.
Okay.
So when you talk about stocks, I would say stocks are the basic ingredients, just like cement and steel rods.
Okay.
So you need high quality stocks. So someone qualified to pick those high quality stocks.
Right.
And then some fund manager is required to build that high quality portfolio for you. You need a financial advisor to first create that, similar to an architect.
Got it.
Help you to find the right fund manager.
Got it.
And then with that fund manager, then you need maybe couple of or few fund managers in the right proportion. Then the investment will stand the test of times. That's why I said mutual funds are here, but it is not just mutual fund. It can be any product. You have portfolio management services, you have alternate investment funds, you have some real estate REITs funds, and private REITs are also there. But these, to start with, I would say mutual fund is a very good vehicle. And then once the wealth grows, then you can add even other funds managed by other fund managers.
Now, having mentioned about mutual funds, Deepak, what are the different types of mutual funds, and where should someone start investing within mutual funds?
Mutual fund itself is pretty complex. You have various types of mutual funds, and it is not just equity, by the way. So you have a debt, which is something like you can understand from an FD perspective. So, but then it's a corporate debt, or it's a government treasury. So that is one type of mutual fund. Then you have gold funds, you have international funds, you have hybrid funds.
Okay.
Yeah. And then within equity itself, you have various types of funds. You have funds that invest only in large companies. It's called large cap fund. You have fund that invest in mid and small cap companies. You have funds that invest in sectors. Nowadays, defense was one sector that was booming like anything.
Yeah.
So these are different types of mutual funds. Now again, my advice to everyone would be to hire a professional or do a lot of research. It's your choice. You can look at two categories to start with out of these so many categories that I spoke about. The first one is a flexi cap category, because in flexi cap category you don't have to worry about large cap, mid cap, small cap, or even a sector. You just leave it to the fund manager to see where the value is. And the second category that I'd like is a hybrid category, which is a combination of debt and equity, sometimes even gold and even real estate REITs become part of that. And within hybrid, you have a balanced advantage fund. The fund manager has the ability to increase or decrease equity based on the market conditions. And you get a good market kind of returns with a much lower volatility. So that helps in smoothing the experience that I was talking about.
Deepak, as a beginner, where can I find the best mutual funds to invest in? Where should I start?
There's a website called valueresearchonline.com. It's a pretty straightforward, presents data in a very easy to understand format. So that I think is a good website to begin with. It's also mostly free of cost. One is Advisor Coach, not very popular. And you can also look at one more, which is called primeinvestor.in.
Okay.
Yeah.
Okay.
Yeah.
Deepak, having learned a little bit about equity right now,
Yeah.
let's move into real estate and gold.
Okay.
For now, you have suggested young people to start investing in equity. The older generation or my parents and so on and so forth, they always recommend real estate and gold. Where is this difference in perspective coming from?
Yeah. Why equity? Why they never said equity?
Yeah.
So I think our elders were very wise, and they inherently understood that both gold and real estate beat inflation in the long run.
Okay.
In India, we have seen that. So they recommended to invest into gold and real estate, and they also felt that it is relatively safer. But why equity never came into question, or they were afraid of equity, is predominantly, I think, because the regulation was not so strong those times. So there were periods of scams. You would have, if you remember, Harshad Mehta scam in the 90s,
Yeah.
and Ketan Parekh's scam in the early 2000s. And a lot of people lost money because of those scams. So it was a scary kind of a time those times. But nowadays regulation is very fairly strong.
Yeah.
So you would not have heard these kind of scams in the last decade or so. The second reason is still valid even today.
Mm-hmm.
And what I believe is the second reason is greed. Yeah. So people use stock market to gamble. People want quick bucks.
Yeah.
And a lot of people lost money because of that. Even though there was no scam, people might have lost money if they were thinking of buying a stock and then selling it, within a month or within few days, and doubling their money, those kind of things, and investing on leverage kind of a thing. So that is probably the reason I think they did not think of equity, or they did not advise on equity. Serious, long-term, disciplined, patience. You need to have a lot of patience. Very boring kind of investing is what I like.
So Deepak, who should consider investing in real estate, and what are the benefits and risks involved in real estate?
Real estate is a good investment, but I believe it is more suitable for high net worth individuals.
Okay.
Because middle class or upper middle class kind of a person, if he's investing into real estate for investment, then just one asset class will suck up all your investment. So then where is the diversification?
Got it.
And if you look at the past data, we can look at past so many years of data, you would see that equity has beaten real estate or gold by a fair degree of margin. So any investment portfolio without equity is not a good investment portfolio, especially for young and middle-aged people. Post-retirement, it could be different.
Okay. So Deepak, within real estate, should one invest in a home or rent a home? What are the pros and cons there?
Yeah. So see, I would say it's more of a personal choice.
Okay.
If you bought a home for your own, living, I would say it is more of a lifestyle, and I don't even call it as an investment.
Okay.
You ask me as a financial advisor and you ask me to calculate and try to give you a post-tax kind of all thing, then maybe rental may be slightly cheaper because in India rentals are not so high. You can get a very good house at a 3% kind of a rental yield. So if you have $100 and you put that into any good investment which can yield you 12 to 15% kind of returns, you are paying only 3% to rent a house.
Gain of 12%. Yeah.
So, but I would say that I don't want to treat everything so mathematically, though it is you would like me to do that since I'm a financial advisor. But I would say that let's leave it to the individual. It's more of a personal choice, and don't consider that as an investment. It's more of a lifestyle. Just like you want to own a car, you want to go for holidays, you may want to own a good house. There's nothing wrong about that, but don't consider that as part of your assets.
Okay, got it. Okay.
Yeah.
So Deepak, moving on from real estate to gold.
Yeah.
Why should someone consider investing in gold in the first place?
So again, see, the thing is, gold is considered as a hedge against inflation.
Okay.
But what does that mean? I'll give you a live example. Actually, one of my cousin, he is a doctor and he was working in Libya.
Okay.
As a senior pathologist, almost a decade ago. And war broke out in Libya, as you might have remembered. He was pretty smart, so what he did, he converted all his cash into gold immediately. And believe me, gold was the only asset that retained its value. The currency was depreciating like anything. But gold did not lose value because it's a globally accepted thing. It's fairly liquid. And it's considered to be a storehouse of value. So from that perspective of a very, very, bad kind of, worse kind of a scenario, maybe gold can come to your rescue. So for that rainy day, maybe some allocation, maybe around 5% allocation to gold is prudent. One can have that.
Okay.
But having said that, if someone is starting a wealth creation journey, it is better to
start a little later.
Add gold when you have built something.
Got it.
Rather than, immediately start beginning in the first place.
Got it. Deepak, if someone wants to invest in gold, how do they go about it?
Yeah, so you can, one is a physical gold, which we all are aware of, which has its own hassles of storing and things like that. And also the quality of gold is questionable. The other is a gold ETF, where what you can do is you can buy a gold ETF, which is backed by pure gold. And a lot of people are not aware of this. So if you buy, let's say, 1,000 rupees worth of gold ETF, 1,000 rupees worth of gold is bought by that ETF provider and it is stored into a warehouse. So it's a good way of owning gold. The third way, which is also there, is to buy a sovereign gold bond, which I think, as far as I understand, government is more or less going to discontinue that. So that option is.
Deepak, having discussed a little bit about asset classes, what are your views on insurance? Broadly, say health and term, or life insurance and health insurance is what I want to understand from.
Earlier, there used to be traditional plans, which we call as endowment plans, which was a mix of investment and insurance. So you have to invest every year certain amount or every month certain amount. If you don't die, you still get something in return, which is almost lesser than FD kind of returns. And if you, for some, God forbids, lose your life, then your family also gets some additional insurance plus all the amount that is accumulated. So in our experience, and it's a very simple maths, if you do that, you will figure out that it's not a very good investment. Neither it's a good investment, neither it's a good cover. Because if you reasonably want to cover, the thumb rule is you need to have at least 10 to 15x of your yearly income as a term insurance, as a cover, as a life cover, whether it is term insurance or whatever it is. To be able to take a cover of 2 CR from an endowment plan, maybe you have to invest everything that you are earning. So the amount of money that is required is huge.
A pure play, a term life insurance would require a less
much lower amount, much lower amount.
Lower premium, right?
Much lower premium, but you won't get anything back. So that is an ideal way of taking a proper cover, and you don't lose also much because the remaining money you can invest into better instruments.
Got it.
So that is what I would typically talk about life insurance. From a health insurance perspective, it is we have seen that people make one common mistake, which is that they feel that they are already covered by their company,
Okay.
especially people who work, and they feel that why do they need to have a personal health insurance in addition to that, or we'll worry about it later once we are out of job. I would say it's not a good approach. It is prudent to have a personal health insurance, right in the beginning of your career, because at that time you are fit, you don't have any lifestyle disease. Later, if you acquire some lifestyle disease like diabetes or hypertension, it is difficult to get a good insurance. Maybe you have to pay more premium. So people don't know that if you take a cover today while you are fit, you can renew it lifelong. Even if you acquire a complex or a life-threatening disease in the future, the health insurance company will have to renew it. They cannot say no to it as per IRDA guidelines.
Deepak, I'm sure my audience would have gained substantially from your insights. But having been in the financial advisory space for the last 10 years,
Yeah.
what are your learnings that you would want to share with my audience?
Not to over-optimize stuff.
Okay, what do you mean by that?
See, as you know, my background is an engineering background,
Right.
and we try to optimize things as an engineer. And I would have seen that people who have invested with us typically are that kind of a background, and they also like to optimize. So they want to maximize the returns, for example.
Right.
I would say that that's not probably a good approach. It is good to have a good balance.
Okay.
Because life is not like maths. Yeah, life has its own ups and downs.
Yeah.
No one predicted, for example, COVID. Yeah, and I have seen cases where people, though we prepared a good financial plan, and the plan was to keep on investing for the remaining 20 years. Yeah, because you are like in your mid 30s, and then the plan was to invest for your retirement. And let's say, since it is 20 years plus kind of investment, let's say we put everything into equity. But then when COVID hit, and people lost jobs, they need money to survive to that time. Yeah, you don't even know whether you'll survive tomorrow.
True.
Or not. So then at that point of time when the market was down by 30-35%, would you be having the courage to take that money at a loss?
Right.
And again, it's not the right thing to do also, because it's your hard-earned money and now you have to take it, withdraw it at a loss.
Yeah.
So this over optimization doesn't work. It is very important to have sufficient buffers and plan for certain things that are not planned for. Because you never know what can happen in life.
Yeah.
So that is something that we have learned. Second thing that we have learned is to have everything properly documented at one place. So again, from our experience, we had, unfortunately, a couple of customers who lost their lives during COVID.
Okay.
So when we did the plan, they said, okay, I have, let's say 2 CR of term insurance. We had that in our notes, but the document was not available. And even the spouse was not aware, unfortunately. The spouse even did not know that they have term insurance. So then it was a struggle to find that document and then claim, because without document or without the policy number, how will you claim?
Yeah.
So it is very important to streamline all your investments, your insurance products, etc., at one place.
Yeah.
And keep it in a vault.
Absolutely.
And make it accessible to your family.
So Deepak, now that we're talking about this concept of FIRE, right? Financial independence and retiring early. How is this concept relevant these days, and how can someone plan for it? It's being talked about. Everyone talks about FIRE these days.
FIRE is on fire nowadays. Yeah. So I think this is very relevant in today's world.
Yeah.
Because in today's time, we have shifted to a nuclear kind of a family. You cannot rely on your family or your children for that matter. So you need to plan for your retirement properly. Now, why retire early? So again, in the current context where people are working in private jobs, no one wants to keep you till 60, right? So it is the need of the hour to plan for financial independence. You may continue to work. But from a planning perspective, it is always good to plan to retire, to become financial independence early. It doesn't mean that you are going to retire. You can retire early from a job that you don't like, but you can still continue to do something that you like.
Yeah.
So that's why I think FIRE is important.
Okay. Deepak, how much money is needed for financial independence? Is there any thumb rule for that?
Retirement is a complex calculation because once you calculate or once you have the fund, your expenses keeps on growing based on inflation. So from a thumb rule perspective, in the West, people have come up with a thumb rule of 25x of your annual expenses.
Okay, got it.
Yeah. So if I am, let's say, spending a lakh a month, so annual expenses 12 lakhs per annum, you multiply that by 25 is a reasonable kind of a corpus.
3 crores.
From their perspective.
Got it.
But those are low inflation kind of countries. So from an Indian context, maybe a 30x or to 30 to 35x kind of a range will be more comfortable. Yeah. Having said that, it will be enough only if you invest that money properly.
Yeah.
If you follow proper retirement buckets, short-term bucket you use for your regular day-to-day expenses, medium term is slightly you take some risk so that it gives better than inflation, and the long-term bucket you take slightly more risk because it is not going to be used for the next 10 years or so.
Okay.
So if properly it is invested, then this kind of calculation is enough.
Got it.
Otherwise, this itself will not be enough if you are going to not invest it properly, and the investment itself is not yielding more than inflation kind of returns.
Got it. Deepak, some questions for a quick answer. What's a common mistake people make while investing in equities?
Yeah, the biggest mistake they make is they invest in equity for short term and they invest in debt for long term.
Got it. Okay. So Deepak, pick one. Group health insurance provided by office or personal health insurance?
Personal health insurance for sure.
Okay.
And group health insurance will be my backup.
Got it. Okay. Pick one of them, FD or equity?
Yeah, so FD for short term, equity for long term.
Okay. Physical gold versus digital gold?
I would be in favor of physical gold.
Okay.
And in fact, a mix of physical gold and a gold ETF is what I like.
Okay.
Digital gold is a no-no because what is being sold in the market as digital gold does not have the backing of real gold. So it is just a paper.
Gold ETF is better than digital gold?
Gold ETF is backed by pure gold.
Okay.
So there's a difference between digital gold and gold ETF.
Okay.
So mix of gold ETF and
physical
gold is good.
Got it. Pick one, Deepak, international investing versus investing in local stocks, domestic stocks.
Yeah, for me it's a desi investing with a tinge of international investing for better flavor.
Okay. Got it. Deepak, term insurance versus endowment policy?
Term insurance is the straightforward answer.
Any day. Okay. Yeah, okay. Deepak, one other question. If the investments in equity is lucrative, is it okay that someone takes a loan to invest in equity?
It's a big no. It's a big no. See, this is again, I would reiterate, it is very, very important to consider investment for long term and not to consider that as a gamble, not to consider that as an instrument to make quick bucks.
Okay.
So if you take a loan and invest, and if it goes down, then you get screwed up royally.
Got it.
So never do that is my advice.
Got it. So Deepak, how about F&O, futures and options?
F&O. Do you remember if you open any broking website nowadays?
Right.
Have you logged in?
Absolutely. I log into Zerodha. Yeah.
Great. So when you log in, you must be getting a message that 9 out of 10 people have actually lost money in trading into F&O.
Right.
But in reality, believe me, that 9 out of 10 is a conservative number.
Okay.
As far as I know, only 1% people actually make money in F&Os.
Okay.
So we need to understand it conceptually.
Yeah.
So when you talk about investing, you are talking about owning a company which is growing its revenues and profits over a long period of time. But when you are doing a trading, that too on leverage, means you have taken, F&O is nothing but on leverage, which means inherently you have taken a loan.
Yeah.
So when you are putting that money for trading for very short term, you are actually not owning that company, right? It's just a contract.
Yeah.
It's just a contract that if this happens, if the stock goes above this much value, then I will make money. If it goes below this, then I will give you money. So it is a zero-sum trade. Yeah. Someone who is making money on the expense of someone else. So my advice is, don't, if you want to, get high, don't use stock market to get high, or don't use FNO. Use some other means.
Got it. Got it. Deepak, I completely understand the importance of a financial advisor. But when should someone hire a financial advisor?
What we do is we do run some Google ads, and people do click on those Google ads, and then they approach us.
Okay.
People who are searching
Mhm.
for a financial advisor, lot of them already had a good sizable corpus.
Okay.
Yeah. And when we tried to look at their portfolio, it was decently good. So we said, you seem to have a fair bit of understanding of
Yeah.
investments. And we in fact asked them, why have you invested this? And a lot of them said, this is for my retirement fund.
Okay.
So they in fact already had a purpose also, to some extent. So we said, you have a purpose. So that means you have some facets of financial planning. You understand, investments. You have a good portfolio already. You have created a sizable portfolio. Then why do you need us?
Yeah.
So we got a fantastic, and this is a common thing that we heard from a lot of people.
Okay.
Now it's my hard-earned money, and I know that if I make one small mistake, the cost is going to be very high for me. So this is something that I really want to not take any chance anymore. And now I am coming to you. So probably that's a good yardstick. But nevertheless, a lot of people do come initially itself. And I just wanted to share this experience that we had.
Okay, Deepak. Deepak, your final thoughts.
Yeah. So, Kishore, I would say my take is that investment should bring peace and not turmoil in one's life.
Okay.
Yeah. So we should design the investment journey in such a way. And we spoke about compounding and basic tenets of wealth creation. I would say compound not just your wealth, but also compound your good karmas.
Wow.
Because wealth you will be able to create in this world, but you will leave it when you leave this world. But good karmas is something that will go along with you.
Wow.
So that is something that I believe in. Warren Buffett says, save before you spend.
Yeah.
Swami Shivananda of Divine Life Society says, first you give, then you get. So I've combined these two philosophies, and I have my own version.
Yeah.
And this is my advice to anyone who is starting or already started, recently. I would say first you take out some portion of your earning, let's say 3 to 6%, and you keep it for charity, something that you feel someone is needy, and you don't have to really go, too far. You can find people once you have that kind of a thought process. Second thing is you take out some 25 to 30% of your income, and you start investing regularly, in a product, a well-regulated product like mutual fund, which we have already discussed, and you continue that. Third important thing is you ensure that you have reasonable insurance. So 10 to 15x of your annual income as a thumb rule for life insurance, and at least 10 to 15 lakh of personal health insurance if you are living in a tier 1 city. So once you have all of this, then I would say yes, you have achieved something. And then comes the most important part, which is not to touch this.
Got it.
Use this only as your retirement kind of a corpus for your long-term goal. Don't touch this in between, this amount of money. Any other goal that you might have, let's say you want to buy a house or you want to buy a car, etc., you have a separate investment bucket for that and use it for that. But this, what I'm talking about, is for your retirement, for your long-term goal. Don't ever touch it. You can move investment from one fund to another. If some fund is not doing well, you can do some pruning, some gardening, all that you can do, but don't take it out. Don't uproot that.
Got it. Deepak, any personal finance books that you would want to recommend for our viewers?
Yeah, so I would recommend two simple books.
Okay.
One is Rich Dad Poor Dad by Robert Kiyosaki, and the other one is Psychology of Money, the one that you had also
Summarized
about. So that these are two fantastic books, very simple and simple to read and understand.
Right.
And I would also recommend one spiritual book
Okay.
that I really like a lot. The name of the book is Sure Ways of Success in Life and God Realization. This is written by Swami Shivananda of Divine Life Society.
Great. Okay. Thank you so much, Deepak, for coming over. Really appreciate your time.
Thank you so much for inviting me. Had a very good time, Kishore. Thank you.
Thank you so much for watching the entire episode. Remember, these conversations are just the beginning. What you do with these insights is that truly matters. If you liked this episode, please share it with at least one person who could benefit out of it. If there are any pointers that resonated with you, if you have any inputs, please share it in the comments below. I would love to hear your thoughts. Stay curious, and until next time, this is Kishore signing off.